Hello everyone, in this video today we're going to be going through the topic of the lower of cost or net realizable value and the lower of cost or market. Okay, and basically these are just two methods of valuing a company's inventory, and we're going to go through both of them, and we'll go through a practice problem for each one. Okay, so first, lower of cost or net realizable value. I'm just going to call this LCNRV. You'll probably hear referred to in that way in your class as well, just because it's such a long name. But anyways, it's basically a method of valuing inventory that states inventory on the balance sheet at the lower of the inventory's cost or its net realizable value. Okay, so it's kind of like in the name, it's the lower of the cost or the net realizable value. Okay, and whichever one of those two is lower, that's the amount that you state on the balance sheet as the inventory's value. Okay. So first of all, what is net realizable value? Well, it's the selling price of the inventory less the cost of completion, disposal, and transportation. Generally, these costs are like cost to complete and sell the inventory. Okay, so as an example, let's say we have this company and they're going to sell a piece of inventory and they think they'll sell it for $500, so that'd be the selling price, right? And the cost to complete the inventory are $30, and then the selling expenses are $20. The net realizable value is $450, because again, net realizable value is the selling price less these costs of completion, disposal, and transportation, which are the cost to complete and sell. So the selling price is $500, cost to complete and sell are $30 and then $20. So 500 minus 30 minus 20 is $450. Okay, that will give us our NRV. Okay, it's not given here, but then we would have to compare the NRV to the actual cost that we initially paid for the inventory, and then whichever one of those two is lower, that's the inventory value. That would be what we would state on the balance sheet for the inventory's value. Okay. Next, companies that use FIFO, weighted average, or specific identification cost flow assumptions must use LCNRV. Okay. So if you use any of these three cost flow assumptions, then you must use LCNRV to actually value your inventory on the balance sheet. And then this idea of LCNRV and also LCM is based on the principle of conservatism, which is basically like understate assets, overstate liabilities. Okay, conservatism basically says, it's not exactly this is a shorthand way of looking at it, but basically what it is, if we were given the choice to overstate assets or understate assets, what would we do? We would understate them because we don't want to overstate assets. Because then investors will be misled, right? They'll think that the company's more valuable than it is. We would rather understate an asset and be more conservative in the sense that we're saying that the value is worth less than it actually is, okay? And so basically the reason that that's conservatism here is because we're stating it at the lower amount, right? We're stating at the lower of the cost or the net realizable value. So in that way, it's built into it to say, we're gonna state this asset at the lowest possible amount because we don't want to overstate the assets. We don't want to say this asset's worth 100 when in fact it's only worth 80 or something like that, okay? And if it's only going to bring us $80 of value, we don't want it on the balance sheet at 100 because then investors will be misled, right? Okay, so that's basically conservatism, okay? And then companies may apply LCNRV on individual items. Major categories of inventory are on its whole inventory, okay? So you can apply this basically to their individual items, to major categories of inventory, or to its total inventory. Okay, this is just like a conceptual point, what exactly that means. It's not like a big deal, but that's something you could just kind of memorize, okay? So yeah, but just as a quick note, okay? LCM, lower of cost or market. Okay, this is a method of valuing inventory that states an inventory on the balance sheet at the lower of the inventory's cost or the inventory's designated market value. Okay, the designated market value is the market, okay, basically, so it's the lower of the cost or the market. It's kind of the same thing as above. It's kind of in the name what we're doing, okay? So this designated market value, what is that? Well, it's the middle value between the inventory's net realizable value, the inventory's replacement cost, and the inventory's NRV less a normal profit margin, okay? So, for example, if a piece of inventory has an NRV of 50 or a replacement cost of 35, and an NRV less a normal profit margin of 40, the designated market value is 40 because that's the middle one, right? It would basically be 50, 40, and then 35. So the middle one is 40. Okay, so it's just basically you line them up, and whichever one is in the middle is the one you always pick for the designated market value. Okay, and then once you have your designated market value, you compare that to the inventory's actual initial cost that you paid, and then you pick the lower one. Okay. Now, companies that use LIFO and the retail inventory method may use LCM instead of LCNRV. Basically, what happened was that LCM used to be sort of the gap in this area, and it used to only be LCM. But then more recently, the FASB has decided to go ahead and put out this new standard with LCNRV. And companies that use LIFO methods and also the retail inventory method, which is discussed later in the class, basically they didn't like having to switch to LCNRV from LCM, and so the FASB allowed them to stay on LCM. Okay, and then again we have these same two bullets at the bottom that we went over at the top. I just repeated them because they apply equally, so for both methods, because they're basically two methods of doing the same thing. It's just that the only reason that this LCM exists anymore is because of what I was just talking about with LIFO companies and retail inventory method companies. Like, they didn't want to use LCNRV, so the FASB let them use LCM for now. Okay, and again, it's based on the principle of conservatism, and companies may apply LCM to individual inventory items, major categories of inventory, or its entire inventory. Okay, so that's basically the brief introduction to the topic. Next, we have how to record the LCNRV or LCM journal entries. Okay, companies use the following accounts. I'm just basically listing all the accounts here, so that way we can get used to them because there's a lot of different accounts, okay? And then companies use the following accounts to record journal entries for LCNRV and LCM, okay? We have cost of goods sold, we have inventory, loss due to decline of inventory to NRV, loss due to decline of inventory to market, allowance to reduce inventory to NRV, and allowance to reduce inventory to market, okay? The specific accounts used depend upon which methods the problems tell you to use, okay? So don't worry, like, obviously there's a lot of account names. A lot of those are new account names and they're very long, but we're going to go through, okay, when would you use one account versus the other? I just want you all to be aware of these are all the possible accounts that you would use, and you could even refer back to this and be like, okay, these are the accounts that I could basically pick from when I was making a journal entry, okay? But once we've gone through this and once you understand, okay, the topic as a whole, the problem is going to tell you, like, whether it's a quiz or an exam or a homework problem or whatever, it basically should just come out and tell you, okay, this is the method you are supposed to use, okay? And whatever method it tells you to use, that is basically the one obviously that's the one that you use, right? So, like, you're not going to have to determine, like, which one to use necessarily, but once they tell you what to do, which methods and stuff like that, you need to know what to do from there, okay? So then there's basically two methods to record the income statement effects of LCM and LCNRV and LCM journal entries, okay? We have the cost of goods sold method, we have the loss method, okay? So the cost of goods sold method, this method debits or credits cost of goods sold when reducing or increasing the carrying value of inventory, right? That's what we're doing here. We're changing the carrying value of our inventory, right? Because we're basically marking it to market, right? And so whenever we change the value of our inventory, we might have to use a cost of goods sold account. If we're using the cost of goods sold method, we use a cost of goods sold account. Okay, then we have the loss method. This method records, this method debits or credits loss due to decline of inventory to NRV or loss due to decline of inventory to market when recording, reducing or increasing the carrying value of inventory. Excuse the repeat there. But basically, whenever we're changing the carrying value of the inventory, okay, we're going to use one of these two accounts, either loss due to decline of inventory to NRV or loss due to decline of inventory to market, okay? And this one is for LCM, and this one is for LCNRV, okay? And it kind of makes sense because, you know, we're doing it to decline to NRV, and this one's decline to market, right? So like market, LCM, lower of cost or market, NRV, lower of cost or net realizable value, kind of makes sense. And then we're going to go through this, and then we're going to have one more quick point here, and then we're going to move to the problems, okay? So that's basically recording the income statement effects. Then to record the balance sheet effects of these journal entries, we have the inventory method. This method debits or credits inventory account directly to reduce or increase the carrying value of inventory, okay? So whenever we're increasing or decreasing the inventory balance, if it says use the inventory method, or basically to, you know, debit or credit inventory directly, then you just do that, okay? Allowance method, this method debits or credits either allowance to reduce inventory to NRV or allowance to reduce inventory to market to reduce or increase the carrying value of inventory. Okay, so again, this one would be LCM, this one would be LCNRV, just kind of makes sense within the name, right? And the other point I want to make here is that these look like 4 separate methods, right? But what's going to happen on a problem is that the problem is going to say something like use the cost of goods sold method and the allowance method, or use the loss method and the inventory method, okay? Or use the loss method and the allowance method, okay? And I guess the last, one would be cost of goods sold and inventory. Okay, so basically the problem is going to tell you like which of these methods to use for both the income statement and the balance sheet effects of these accounts. And so you just have to do what they say, okay? And so basically what that means is that if they say use the loss method, you got to be using these accounts, right? If they're saying cost of goods sold, use cost of goods sold. And the same thing down here, use the right accounts, okay? That's the first point. And the second point is, some students get confused about this. Cost of goods sold and loss method, they're not necessarily like, cost of goods sold is not specifically related to inventory and loss is not specifically related to allowance. You can use any combination, as I just wrote out here, right? Like any combination you could think of, cost of goods sold with allowance, cost of goods sold with inventory, loss with inventory, loss with allowance. Like, it doesn't matter. It's just the problem has to tell you what to do, okay? So basically, that's pretty much it for here. The only other note is that the allowance method, okay, these allowance accounts are basically going to reduce the balance in the inventory account, okay? So it just says reduce or increase the carrying value of inventory. Generally speaking, these allowance accounts are just going to reduce the balance in our inventory account, okay? So that's sort of a conceptual overview of the topic, okay? Now let's go ahead and let's just run through a few problems, okay? And so we have these examples of LC, NRV, and LCM. And again, I have a note at the top. When explaining the following examples, stress that the loss and cost of goods sold methods are not exclusive to just inventory or allowance methods, like we just talked about, right? Like you can use any mix, you can mix and match them, right? Like it doesn't matter if the loss method goes with inventory, it's not necessarily true. It doesn't necessarily go with the allowance method. And the same thing with cost of goods sold, right? Like you can mix and match the methods, okay? It's just whatever the problem tells you to do, that's what we end up doing, okay? So, and then the other thing is you kind of have to memorize the account names, right? Like they're long and it kind of sucks, but that's just the fact of the matter that you need to memorize them. And so I would just take some time and just memorize the account names, okay? So first, LCNRV. XYZ company is attempting to determine the value of its inventory as of December 31 of 2016. XYZ uses LCNRV method to value its inventory. The company has the following data related to its inventory at December 31 of 2016. Okay, so we have the items here and then we have the amounts here. And then basically it's telling us to prepare a journal entry for XYZ to record the write down of the company's inventory. Assume that the company uses the loss method and then the allowance account for inventory. Okay, so basically this is telling us, right, we're using the loss method and then we're using the allowance method, right? It's basically just straight up telling us that, right, in the problem. Like, and it's going to say that in the problems that you would need to do, okay? The homework ones are not, like, as good, but definitely the ones on the exams or quizzes, like, the professors or the TAs, like, they're not going to keep you guessing about which method to use. Like, they're not trying to trick you in that way. Like, they're not really trying to trick you at all, but, they're not trying to trick you into using, oh, okay, we got them, like, it was supposed to be cost of goods sold, but they used loss. Like, no, like, if you know what you're doing, it will just come out and tell you what the method is. So if you know what you're doing from there, you should not have an issue solving the problem, okay? It shouldn't be ambiguous in that way, okay? The other thing is recording a write-down of inventory. What does that mean? Well, when we write down something, it means that we reduce the value of it. Basically, so for an asset account, right, when we write down the value of an asset account, that means we're reducing the value of the asset account. We're reducing the balance in the asset account, okay? But the thing is, we have to even determine, is there even an entry necessary, right? Because if there's no entry necessary, we just write no entry, right? Okay, so what do we have to do? Well, we're using LCNRV, right? It tells us that. Okay, and then it tells us all these things. So when we do LCNRV, the first thing that we need is our cost, right? So cost is $5,000, okay? And then the second thing that we need is the actual net realizable value. Okay, if we remember back, net realizable value is the selling price less the cost to sell, less the cost to complete, right? So that would just be $5,500 from here, $400 would go there, subtract subtract 200 more for the cost to complete the inventory. That'll give us an NRV of $4,900. So we compare, the lower one is the NRV, so the value of the inventory is $4,900, right? So that would mean that we actually do need to reduce the balance of the inventory, right? Because currently it's on the books at $5,000, but we only want it on the books at $49,000. So we have to reduce the balance of the inventory account by $100, right? So our journal entry, again, it tells us to use the loss method. That means we're going to debit loss due to decline of inventory to net realizable value, and then allowance to reduce inventory to net realizable value for $100. Okay, these account names, again, they're all listed up here, and then they're kind of repeated again here at the bottom. Loss due to decline of inventory to NRV, allowance to reduce inventory to NRV. Okay, for the loss, because we're using the loss and the allowance method, that's what the problem tells us. And then we have all the account names listed here again if you need to refer back to those. Okay, so that's the first part of it. Now it says, same as above, but we're going to change the cost to sell to $100. So now the cost to sell is only $100. Okay, so now the cost is still $5,000, right? That doesn't change. The estimating selling price is still $500. The cost to sell are only $100 now. The cost to complete are still $200. So now the NRV is $5,500 minus $300 basically. And that means that the NRV is $5,200. Okay, so now we have to compare which one is lower, cost or NRV. Well, in this case, actually cost. Lower is cost. So we value the inventory at $5,000, which means that we have no journal entry. And the reason we have no journal entry is because we already have the inventory stated on the books at $5,000, right? So we don't actually need to adjust the value of the inventory at all. It's already stated at $5,000 on our books. We can't write the inventory up, right? Because in the name, it's LCNRV, right? It's lower of cost or net realizable value. We're picking the lower one. I apologize for the noise in the background. They're mowing the lawn or something like that. But anyways, we're picking the lower one, okay? And so the lower one in this case is actually just the cost, okay? So that is the first example for LCNRV, okay? Then what we're gonna do is that we're gonna say, so this first example here, okay, it is, we're doing it as of December 31 of 2016. Okay, now what we're going to do is that we're going to say, assume the same facts as the original problem, but now it's the end of the next year, right? It's the end of 2017. Assume that the company did not buy or sell any inventory during 2017 and they had the same items in its ending inventory as the previous year end. The following information is available for 2017. Okay, now we have all our cost information, everything like that. It says, prepare the journal entry for XYZ to record the write-down of the company's inventory. Assume that the company uses the loss method and the allowance account. So they're still using loss and allowance. Okay. Now we're going to have to do the same thing as we did last year. Okay. But we're going to get a little bit of a different result. Okay. So first is cost. Cost is still $5,000. NRV. Now they think they can sell it for $5,700. The cost to sell and complete are basically $400 and $200. That gives us an NRV of $5,100. Okay. Now the lower is cost. So we want to value it at $5,000. Okay, so if we go back to last year, this first part here, right? The second part, we're going to ignore this, right? This was just sort of like a different assumption. This is the main assumption we're working on. Okay, so basically what happens is we value the inventory at $4,900, and the way that we did that was we debited the loss and we credited allowance. Okay, so now our inventory is stated at $4,900. However, now we want the inventory to be stated at the lower of cost or net realizable value at the end of 2017, which is $5,000. So that means we have to actually increase the value by $100, right? Because it was at $4,900. Now we want it to be $5,000. Okay. So the way that we can do that is that we will actually debit allowance to reduce inventory to net realizable value by 100, and then credit recovery of loss due to decline of inventory to NRV by $100. Okay, this recovery of the loss, it's not a gain, right? We're recovering the loss from last year, right? We suffered a loss last year of $100 because the inventory, the NRV was lower than the cost. We had to write down the inventory. Now we're kind of somewhat writing up the inventory, right? We're increasing the balance in the inventory. However, we must note that when we make this write-up, we can only write the inventory up to its initial cost, right? So we can never write this inventory up over $5,000. Because doing that would basically be saying that we're increasing the carrying value of the inventory above its initial cost, and we're not allowed to do that within US GAAP. Okay, so that's why people might be careful be careful not to write it up by 200, right? Because if it's 5,100 now, well, we might want to think, oh, we will recover $200 of a loss, but we can't do that. We can only recover what we've lost in the past, right? So it says you cannot recover more than up to the cost of the inventory. Okay, so you can recover up to the cost of the inventory, but you can't recover more than that. Okay, so that's sort of just an extra complication I thought I would throw in there just to go over that really quickly. Okay, now we have a quick problem for LCM, and then this is the end of this video. So we have ABC Company is attempting to determine the value of its inventory as of December 31 of 2016. ABC uses LCM method to value its inventory. The company has the following data available related to its inventory for December 31 of 2016. Okay, and then we're given all this information again. Now it says prepare the journal entry for XYZ to record the write down of the company's inventory. Assume that they use the cost of goods sold method and then the inventory account directly. Okay, so basically what that means is that they're using basically the cost of goods sold method and the inventory method. Okay, so when we're doing that, the accounts we're using are cost of goods sold and then just inventory. That's basically what we're doing. Okay. So then what we need to do, if we can remember from our first page, is that, let's just flip back to that really quickly. The first page, okay? We need to determine the designated market value. And again, we need to do that, we need to figure out the middle value of the NRV, the inventory's replacement cost, and the NRV less than normal profit margin. Okay? So we need to determine those three values, then determine the middle one. Okay? So first we have our cost, it's just given, $6,000. Then we can determine our NRV. Okay, so our $7,000 is our selling price. We're going to go through this one a little quicker because we've gone through NRV like a couple times now. Cost to complete and sell, $600. So NRV is $6,400. Okay, then the replacement cost is given at 56, so that's $5,600. Okay, then this one is the only real difference that we've had. Okay, is this is the only thing that's all that challenging. But basically, what you have to do is you have to do NRV less than normal profit margin. Okay, so it tells you normal profit margin is 10%. The thing we have to be careful of here is that the 10%, what are we taking 10% off? We're taking 10% of the selling price. Okay, so this is $7,000 times 0.1, okay, which is $700. Okay, so then what we'll do is that we'll do 6,400. We'll take the NRV, we'll subtract away the normal profit margin, and we'll get $5,700. Okay, the middle value is 5,700. So that will be our designated market value. It's the NRV less than normal profit margin. Okay, that's the middle value. Okay, and again, just to go over that really quickly, okay, because we're almost done. Just to go over this part really quickly, we always solve for NRV first, then we take NRV from there, and we subtract away the normal profit margin, meaning we subtract away the percentage that gives us times the estimated selling price. Okay, we don't take this 10% right here and multiply it by NRV. That's not right. We need to do the percentage of the actual selling price, the estimated selling price. Okay. Then we do our LCM comparison, so lower of cost or lower of market. Well, which one's lower? Market, okay? So that means we need to write down the inventory by $300 because it's sitting on the books at $6,000. We want it sitting on the books at $5,700. So our journal entry, again, it tells us to use the cost of goods sold in inventory accounts, okay? So we just debit cost of goods sold, credit inventory for $300, okay? So basically, the credit to inventory is just reducing the inventory account, okay? And then the debit to cost of goods sold is increasing cost of goods sold, okay? Because it's basically like we have, it's basically like we have sold the inventory to a certain extent. Like we actually haven't sold it. That's why the loss method makes more sense, like conceptually when you think about it, because the loss method is saying like, oh, okay, the inventory's value is not worth as much anymore, so it's kind of like a loss. This method is a little weird in the sense that it debits cost of goods sold because it's not really cost of goods sold, but if that's the method they tell you to use, that's the method that you need to use. Okay, so that's the end of this topic, and I hope that was helpful.